We have a market that is down across the board in futures. 30 minutes until the start of the cash trade. I'm Matt Miller. Cathy, Greifeld and Sonali Basak are both off. Nonetheless, Bloomberg Open Interest starts right now. Coming up, fresh clues on the impact of Trump's tariffs. Target cuts its forecast, citing weak consumer spending. Meanwhile, resilience in housing. Lowe's bucks the tariff trend with a beat as earnings from Toll Brothers show luxury demand holding up. Meanwhile, a big breakthrough on Capitol Hill. New York and New Jersey Republicans capitulate, allowing Trump's SALT cap to be extended. In terms of the stocks that we're watching this morning, Target front and center, off more than 6% as a pullback in store traffic and a cut outlook hurt investors' profit outlooks. Lowe's sales beat expectations, defying volatility seen by other retailers, so those shares are up 1 1/3%. And NVIDIA's CEO is calling U.S. chip export limits to China a failure. He says it will hurt U.S. dominance in the AI market. But I want to get back to Target's earnings, and we're joined on the desk by Bloomberg's consumer editor, Emily Cohn. Emily, why did Target have to cut its outlook, and how much were tariffs a part of this?
So Target said it was definitely hit by tariffs, but a bunch of other things that they're dealing with too. Boycotts over its DEI pullback, lower consumer confidence. This was not a good report.
In terms of retailers, we had a number of them out. TJ Maxx, another one. How are they doing?
TJ Maxx is a winner here this morning. Their forecasts were mostly in line, a little bit lower than estimates, but seems that they're well set up for this moment. Consumers start to pull back, are more focused on their budget. TJ Maxx gains here. They are pretty well set up for these turbulent times. Their buying model is also different than most retailers. They're not as exposed to tariffs than most of the other big players in this space. So they're in a bright spot.
Yesterday we were talking about, Home Depot and the diversification of supply chains. Do we hear anything about supply chains in the reporting from the retailers that were out today?
Yeah, so Lowe's also beat expectations, and pairing with Home Depot says that the U.S. shopper hasn't totally pulled back on home spending. They're definitely wary of those big projects, anything with big price tags. High rates are going to pull that back, but they're still spending. Small projects are happening.
Yeah, those big projects typically have to be financed, so higher rates are going to hold consumers back. Emily, thanks very much for that. Emily Cohn talking to us about retailers Target and TJX. She mentioned Lowe's as well. That's one that we showed you. It's rising pre-market. That's because Lowe's sales beat expectations. The home improvement retailer also maintained its full-year sales forecast, which kind of bucks the trend of companies polling them. Joining us now to talk more about this is Drew Redding, Bloomberg Intelligence U.S. home building analyst. So, Drew, we heard from Emily about higher rates kind of hurting at Home Depot. Did they hurt at Lowe's as well?
Yeah, so where higher rates are really impacting the home improvement market is in those big ticket discretionary categories. So think about things like kitchen, bathroom remodels, maybe large flooring projects. And the reason is these are the type of projects that tend to be financed. So with rates as high as they are, it's become increasingly prohibitive. At the same time, as we well understand, high rates are holding back demand in the housing market. Recent existing home sales were the lowest in September, and we've been hovering around a low 4 million annualized rate for a couple of years now, which is about 25% below what a normalized environment looks like. So, the high rate environment is certainly hitting the retailers, both on the housing side and on their ability to finance these large ticket projects.
And with mortgages over 7%, it's understandable that this spring selling season is not great. Nonetheless, Toll Brothers, I guess the higher end consumer is still able to shell out cash for homes.
Yeah, no doubt the higher end of the housing market is doing better than the entry-level market. When you think about Toll Brothers, their buyers are definitely more well-heeled. They typically pay about 25% of their buyers in cash. Those that do take a mortgage put about 30% down. That being said, they're not completely immune from what's happening out there in the market. If you think about housing as an ecosystem of buyers, you need demand at the lower end of the market to facilitate trade-up buyers into the price points where Toll Brothers operates. If you look at their orders this quarter, they were down 13%. So while they did beat on closings, margins, and earnings, you have to start to look ahead to 2026, given that Toll Brothers, since they're building larger homes, has a longer build cycle. So if we don't start to see demand improve as we move throughout the year, you could see a slowdown in 2026.
All right, Drew, thanks so much for joining us. Drew Redding there covers housing for Bloomberg Intelligence. Now, NVIDIA CEO Jensen Huang pushing back at the Trump administration's chip curbs with China, also essentially pushing back on Biden's chip curbs with China. He is basically saying that this isn't slowing down progress on AI because the Chinese are just going to they're local chip makers. They're working with Huawei instead of buying chips from American chip makers, namely NVIDIA. Let's talk to Mandeep Singh, Global Head of Tech Research for Bloomberg Intelligence here at the desk. He's saying, you know, if we limit our exports, we're going to miss out on $50 billion in chips revenue from China in 2026 alone.
Yeah, I mean, and look, 50 billion is almost 20% of the GPU market right now, which is about 250 billion. So clearly, you know, the fact that when you look at the LLM companies, the biggest LLM companies are here in the US, but after that, it's in China. You know, they are the ones who are training their model. And even though, you know, Jensen was there in Middle East, they have signed some sovereign deals. When you think about sustainable demand on the GPU side, I mean, it's from the US companies and the Chinese companies. And in this case, Huawei offering an alternative, you know, to their own companies, as well as outside China. In Malaysia, we heard some stories about Huawei setting up a data center with their chips. So clearly, there is that concern that NVIDIA may not be the monopoly when it comes to training and inferencing that everyone seems to think. And, you know, the longer this goes, that's a risk for a company like NVIDIA.
I just wonder, you know, previously NVIDIA has been able to go around these kind of curbs by selling through other markets, like in Singapore. Are they doing that essentially now after their trip with Trump in the Middle East, selling through Middle Eastern markets into China anyway?
I mean, anything is possible, and it's hard to track exactly, you know, how these chips are getting used and in which data centers. But now the scale is becoming much larger. I mean, NVIDIA is a company that's going to do $200 billion in revenue. For it to maintain 20% growth, it needs to find customers of the size of, you know, Microsoft and Meta. And those customers are in China. So if those customers, you know, are not buying NVIDIA chips and they're relying on their own chips, that makes it hard because the scale of this keeps getting bigger and bigger. So that's where the incremental buyer has to be somebody like a hyperscaler. It can't be an enterprise company with $1 million or, you know, $10 million IT budget. It has to be somebody who is spending capex like the hyperscalers
like
are.
a Google,
yeah,
like an Apple. Those two companies
Apple,
in the news,
that's
by the
a big
way,
one, yeah.
Mandeep, as they seek to, I guess, gain some ground back in AI, right? Google, we all used for search. Now a lot of people are using instead OpenAI or complexity.
Yeah.
What is Google doing to fight that? They're going to have a new AI search, I guess, again?
I mean, the event yesterday, I think, had so much in it in terms of AI mode, and then the fact that they launched a new bundle, a $249 bundle. So think about, you know, everyone is using OpenAI ChatGPT with a $20 subscription. They launch a $249 bundle. What that is telling you...
$249 a month?
Yes.
Holy
And
moly.
what that's telling you is AI is expensive. And for them to be able to run this profitably, they packed in a lot. There is YouTube Premium as well as, you know, all their other consumer apps. They're telling you that AI is expensive, and that's a way for them to run this profitably. They can't just do it at $20 a month.
Can I finally ask you, it's a much smaller investment, but you have these Meta glasses from Facebook. And now Google's going to invest with Warby Parker to make their own smart glasses. Will they challenge the Meta glasses? Does Apple have something in this space? Is this the new frontier?
I mean, look, right now the LLMs are so powerful that all these companies are trying to distill them into smaller form factors. And, eyewear is one of those form factors in addition to your phone. So, eyewear can only run a smaller model, but it can be a voice assistant. And that's what they showcase. The use case is if you want to interact with a device, you can do it without pulling out your phone. And I think the fact that they have the best model now that's comparable to OpenAI, that just tells you that they will use it in all the distribution channels they have, whether it's their family of apps running on the phone, their operating system Android, or the Warby Parker eyeglasses.
All right, very cool stuff. Mandeep, thanks so much. You cover such an awesome sector. Mandeep Singh there from Bloomberg Intelligence. Quick check on what's going on in futures. Google fighting the trend going up. S&P futures coming down. Not a huge drop, but after yesterday we broke the streak of wins. We're now losing ground at 59.19 on futures. NYMEX crude is actually up right now because of reports. I think CNN has reported, based on U.S. intelligence, that Israel is planning a potential attack on Iranian nuclear facilities. And as a result, you see crude up across the industry. And then the Bloomberg U.S. dollar index right now down at 12.18. We're going to talk about that throughout the show. Some more movers on our radar. VF Corp falling after guidance fell short of expectations and Vans struggles. Palo Alto's forecast disappoints as it gives discounted products to drive adoption, so not taking as much price as it could. United Health falling after The Guardian reported it secretly paid nursing homes to reduce hospital transfers for sick residents. We'll have to get the company's response to that for you. Coming up, a breakthrough for President Trump's economic bill. We'll have the latest from Capitol Hill on Republicans in New York and New Jersey capitulating to President Trump. This is Bloomberg Open Interest. Let's get to high interest now. Look at what's making headlines around the world. Oil is rallying after a CNN report that U.S. intelligence suggests Israel is preparing for a potential strike on Iranian nuclear facilities. It wasn't clear if Israeli leaders have made a final decision on whether to carry out those strikes, according to CNN. Oil has been volatile since last week on mixed headlines about the fate of the Iran-U.S. nuclear talks, which could pave the way for more oil to return to a market that's likely to be oversupplied later this year anyway. JPMorgan has created a unit aimed at guiding clients through geopolitical risk. The new Center for Geopolitics will release quarterly reports on hot-button issues like populism and artificial intelligence, and its executives will participate in events and host client sessions to provide insights on navigating global tensions. The CEO, Jamie Dimon, has emphasized the importance of addressing geopolitical risk, which he believes is, quote, very, very, very high. Bloomberg has an exclusive sit-down with Jamie Dimon tonight at 11:30 p.m. New York time, so set your DVR. And House Speaker Mike Johnson says Republicans have reached an agreement to increase the state and local tax deduction to $40,000, a key issue in President Trump's economic bill. He appeared on CNN earlier.
That's the agreement we came to, and I think that the SALT caucus, as they call themselves, it's not everything they wanted, but I think they know what a huge improvement that is for their constituents, and it gives them a lot to go home and talk about.
Let's stay on that story. Bloomberg's Tyler Kendall joins us now from the White House. And Tyler, we haven't gotten confirmation from the New York and New Jersey SALT caucus members who I guess would have to have capitulated to agree to a cap on the state and local tax deduction. Do we know a deal is going to go through at these levels?
Yeah, hey, Matt. So there's a lot of different factors that are going into this. Yes, as you've mentioned, we have not quite gotten the confirmation that this is going to be the actual finalized agreement on the table, but our reporting does indicate that as of now, the offer is to lift that SALT cap from $10,000 to $40,000. And then people familiar do tell us that then that cap would phase out above a $500,000 per year income limit. It does not appear that the marriage penalty has been addressed as part of this, something that we know that these lawmakers from high tax states like New York, New Jersey, and California really wanted to see. Now, keep in mind, yesterday, President Trump went to Capitol Hill and downplayed the idea of lifting the SALT cap. A person familiar tells us that inside the room, his pitch was that they could address the SALT cap down the road. But we know that these lawmakers really were digging in because they saw this as a way to make good on a political priority that's really been on the books since 2017 when that cap first went into place. And that really has been playing in to these the so-called SALT caucus's leverage here, that without this cap, before this, it really was unlimited. So going forward here, we're going to have to see how this shakes out because, Matt, we're already starting to hear, perhaps unsurprisingly, from some fiscal hawks that they are unhappy with this deal. That includes House Freedom Caucus Chair Andy Harris, who in an interview earlier this morning said that he felt that Republicans were actually farther apart from a deal than before.
Yeah, it's interesting. Before President Trump put this SALT cap into place, there was none for over 100 years because the framers wanted a dual sovereignty. The states should have been able to tax and govern on their own terms, and this infringes at the federal level. Do we know why Elise Stefanik, Nick LaLota, Mike Lawler, Nicole Maliotakis, why would they agree to anything since this was set to expire, this cap, this year anyway? What would make them agree?
Well, at this point, I did have the chance to catch up with Congressman Mike Lawler yesterday after his meeting with President Trump, and he said that he made the case directly to this White House that the current proposal that had been on the table was not enough. But at the same time, he also did tell me that they do not want to see those 2017 tax cuts expire. So this really does have to go hand in hand with sort of the bigger picture here that they chose to do this as one big, beautiful bill, which means at the end of the day, there's a lot of different priorities that they are having to get through. And while they might not have to negotiate with Democrats, Matt, they do have to negotiate with each other.
All right, Tyler, thanks very much. Tyler Kendall there reporting from the White House. Coming up, JPMorgan's Abby Yoder says the AI trade still has legs. We'll talk about the mega cap tech stocks with her next. This is Open Interest. Morgan Stanley has raised its call on U.S. stocks and treasuries. Strategists expect 7 interest rate cuts by the Fed through 2026, which will support bonds and bring the 10-year down to 345, according to strategists there. They see the S&P 500 reaching 6,500 by the second quarter of 2026. Joining us now is Abby Yoder, U.S. equity strategist at JPMorgan Private Bank. And Abby, when I read this Morgan Stanley story, which is Serena Tang and her team of cross-asset researchers, I thought, wow, 6,500 seems so high, but it's actually below consensus, just slightly below consensus for Q2 2026. What's your expectation for stocks?
Yeah, so we just came out with our mid-year outlook, and in it we do think about numbers that go into the middle of 2026, and while they don't match Morgan Stanley, they're similar in nature in that we do expect the market to hit new all-time highs, and I think really underlying that is what's going on with technology in the U.S. We saw that in 1Q with a lot of the earnings reports from those big the Mag 6, let's call them. And that really is underpinning a lot of our positive momentum, and keep in policy related, like we've kind of moved past peak policy uncertainty and pain in our view, and we're now moving through towards more positive policy implementation.
So these big hyperscalers, right, or AI chip makers or what have you, they obviously powered our run in 23 and 24, and the thought was we'd get a broadening out. They actually brought us down to the April lows, but have been pushing us back up. The valuations have not yet met their levels before April 2nd. Yep. So do they have more room to run?
Well, that's what I think when you're looking at the market right now and you break it down between like the Mag 7 and the 493, what we've seen year to date, to your point, is they're pulling the market down, right? Like they've seen 2 turns of multiple compression this year. The 493 have seen 1 turn of multiple expansion. So they're trading around like 20.5 times, which is like above 1 point above their long-term average of around 19.5 times. But what's happening is when you look at 2025 earnings estimates, which have come down around like 3% for the year, Mag 7 is up, positive earning revisions, and the rest of the market's down in terms of negative earnings revisions. So it's really like you've got a better valuation. Some of these stocks are trading at this, cheapest discount since 2017, and you've got a positive earnings momentum story. That to us is really what underpins our positive outlook.
Is there anything else that you think is a tailwind? Because there have been so many negative headlines. We're growing our deficit even wider. We're putting tariffs on countries at levels that we've never seen before. I mean, what else gets us up besides just these 6 or 7 stocks?
Well, I think we're positive on financials, and I think when we think about what happened to the market post the election in November, it was really what we were calling animal spirits. And when animal spirits are ignited, that means you see more capital markets activity. And that has been essentially on hold to start the year, which is well below expectations coming into the year, obviously. You get like any incremental clarity around what's happening in terms of policy, right, as we move through the summer and get through this reconciliation bill. I think that's where you can really start to see those animal spirits come back. You've got a deregulatory agenda. You've got a ton of excess capital of these banks, close to $200 billion, that they can either do through share buybacks, they can do through M&A, they can do through loan growth. So a lot of different things that I think spell positives for financials, which we talk about in our mid-year outlook as well.
All right. Abby Yoder out with JPMorgan's private bank mid-year outlook. Let's look at some movers ahead of the opening bell. Canada Goose earnings beat, but it pulled full-year guidance due to unpredictable spending patterns. Nonetheless, the shares soar. Take-Two falling on plans to sell $1 billion worth of new stock, and Wolfspeed shares are sinking as well following a Wall Street Journal report that the chip maker is preparing to file for bankruptcy within a matter of weeks. This is Bloomberg. We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We have futures pointing lower today on concern about more pulled outlooks due to tariffs. We're going to talk about Target and other stocks that are doing that today. But you can see U.S. S&P futures down 0.75%. Nasdaq futures down about 0.8%. And the small caps getting hit even harder. You hear the opening bell, and if you look on the Nasdaq, you've got Patriot National Bank Corp. On the New York Stock Exchange, even cooler, I think, although if you're a shareholder in Patriot, you're up 200% year to date. You've got the U.S. Sail GP team. This is like F1 or MotoGP, but for sailing, which is pretty awesome. But even cooler, it makes me think of that dude who is sailing from Oregon to Hawaii by himself with his cat that everyone is following on Instagram and TikTok. In terms of the stocks to watch this morning, Target reported a pullback in store traffic and lowered its outlook as shoppers spend less. Lowe's sales actually beat expectations, defying the tariff volatility seen by others, but those shares are no longer gaining as they were in the pre-market. NVIDIA is down not a whole lot, 0.5%, but for a $2.5 trillion company, that means a lot to the indexes. That CEO, Jensen Huang, is calling chip exports a failure. Chip export blocks a failure because it's not continuing to hold U.S. dominance in the AI market. Joining me at the desk is Julian Emanuel, Evercore ISI Chief Equity Derivatives and Quant Strategist. He says the structural bull market is alive and well, led by AI-centric names and themes. And it's great to have you on. I was thinking about you the other day when I was watching Surveillance, and they were talking to Ed Yardeni, because he says he can't decide if a bond market meltdown or a stock market melt up is more likely. And I thought, stock market melt up? Hasn't that already happened?
No, we don't think it's happened. And actually, because if you look at it, you certainly had some sectors melt up into the election, but we would argue that was not sufficient FOMO because the market cap as a percentage of the total was not large enough.
But Julian, I'm talking about from the April lows. I mean, we're up almost 20% from the lows in April on. I guess only one reason, only the fact that Trump backed down from his China tariff.
Well, that's certainly the biggest factor. No question about it, because before those lows, we were getting calls daily for several weeks asking us whether the Trump administration actually wanted a recession to keep bond yields suppressed. And we always thought that was no, and the pivot really catalyzed the market response. But again, to the point you're making earlier and your previous guest, is that this is a resumption of a structural bull market driven by the AI revolution, very much like the structural bull market of the late 90s, driven by the internet revolution, interrupted by a cyclical bear market. That's over now. But to your point, we have come a very long way very quickly, and we see the headlines this morning. There's still a lot of geopolitical uncertainty out there, and at 23 times earnings, we think stocks in the near term are likely to pause and digest here.
So 23 times earnings for the broader market is far above the historical average, but you're seeing valuations on the Mag 7 that are below their, I guess, recent averages, right? And for tech stocks, they don't look that eye-popping.
No, and again, the earnings dynamics of that sector drive the premium that's been with us for years and years and years and is likely to be with us for years and years. But the difference between the last several weeks and the market's realization of the longevity of this theme is to work that we actually did over the weekend that shows that the use case is proliferating across industries. So executives are actually figuring out how to apply it to control costs and to drive revenue, whether you're an industrial company or a financial company or a travel operator.
Joe Chiaffi in the control room pulling up a bunch of stocks that are fascinating to watch on an intraday level. But show me those stocks or those sectors year to date, because it'd be interesting to see how the Mag 7 is doing year to date. A lot of them still haven't gotten back to unchanged, even though the broader market is already gaining year to date. What's your expectation for the market and for the Mag 7 at year end or into 2026?
So our view is if you look at how bull markets unfold and an interrupted bull market like what we've had into the April lows, there is a tendency for two things. Number one, the stocks that get hit the hardest in the downturn tend to drive the rally. We're seeing that in these names. But it's sort of the double dollop of the fact that those names were the leaders off of the October 2022 low.
Apple's still down 20% year to date.
Yeah,
Alphabet's still down 13%.
Right, but again, go back and look at how much those stocks are up since 2022 or 2020, and you can really say that a lot of this is a longer-term digestion phase, particularly at these multiples broadly, given the policy uncertainty we have.
Julian, speaking of policy uncertainty, and look, thank you, Joe. He's pulled up a 5-year chart, so you can see the amazing returns that these companies have given investors and really with which they've powered the indexes. Speaking of policy uncertainty, what do you make of rates? Right now, we're in what some would have called the danger zone for the 10-year, above 450, right at 453. We're above 5% on the longer end of the curve. Does that concern you? And which direction do you think it's going?
It does. It is definitely a headwind. So a number of weeks ago, we did an analysis of, again, this structural bull market that began at the October 2022 lows. And virtually 100% of the total market's return during that period occurred when yields on the 10-year were 4.5% or below. Very marginal positive returns between 4.5 and 4.75, and negative returns above 4.75. And, from our point of view, the money market investors should be very happy that the big, beautiful bill seems to be moving through, because we aren't going to have to worry about, hopefully, any of the kinds of ructions that we had to think about during the original debt ceiling crisis in 2011. But the flip side of that is that we are, once again, proliferating deficits as far as the eye can see. And as we've learned, there is a shifting preference or a diversification away from U.S. assets, which likely is a multi-year process and doesn't really interrupt what we think is the procession of this bull market, but it's a process.
Also away from states' rights and toward a centrally controlled economy in Washington, but we won't get into that right now. I want to talk about Morgan Stanley, the cross-asset team there, led by Serena Tang, put out their expectation, and they also expect 6,500 in the S&P in the second quarter of 2026. But I thought most interesting was they expect a 10-year at 345 at year-end because they are looking at 7 rate cuts through 2026. That, to me, suggests that economic growth doesn't pick up very much.
Yeah, that sounds a difficult combination to arrive at. So Evercore ISI has been front foot the entire time saying that there wouldn't be a recession in 2025. We are looking at GDP for 2025 on the order of 0.9, but the combination of the policy uncertainty and what is expected to be this boost in inflation that every corporate commentary tells you is coming or if has not already started is going to limit the Fed's ability to cut rates. Now, granted, the political landscape will change when Jay Powell's term of office lapses next year. But to me, that kind of rate cutting environment, I'd prefer it not to happen. We don't think it happens because that probably means that recession odds are much higher.
All right, Julian, always great to get some time with you. Thanks so much for joining us.
Thank
you. Evercore ISI's Julian, Emanuel, if you'll excuse me, I'm going to go take a look at the move screen in the hanging wall. This is the most dynamic way to look at the live market on the Bloomberg terminal. We can see the biggest gainers or the biggest additions to the S&P are Google, Broadcom, and Medtronic, which plans to spin off its diabetes unit as a standalone stock. The biggest subtractions from the S&P index are Apple, as we just showed you, down almost 20% year to date, Amazon and Microsoft, as well as NVIDIA, and then United Health Group after that Guardian report. So these stocks are really weighing on the index. And if you take a look at a breakdown of the sectors, the industrial sectors, you can see that only communication services is up. So this is those big hyperscalers, those big AI data centers, Google right up there at the top. Down at the bottom, you have consumer discretionary, you have IT, and then you have healthcare. Healthcare really dominated by UNH. Coming up, we're going to talk deeply about electric vehicles. ChargePoint is accelerating the build-out of its EV infrastructure, charging infrastructure. We're going to speak to the company's president and CEO, Rick Wilmer, and we're going to talk about Elon Musk's interview yesterday and comments that everybody is doing poorly in terms of European sales. This is Open Interest. Time now for our top call. Some of the analysts' action in focus this morning. First up, Home Depot getting upgraded to a buy at Stifel following its better-than-expected earnings yesterday. Analysts at Stifel see more upside potential now for this year. United Health is getting cut to a sell at HSBC, the company's second sell rating on the street. The Guardian reporting that the insurer secretly paid nursing homes bonuses to cut hospital transfers for sick residents as part of a series of cost-cutting tactics. United Health is calling the report, quote, verifiably false. And finally, AutoZone getting upgraded to a buy at Bank America. The analyst cites increasing confidence in the company's recession-proof history and more favorable dynamics in used versus new car sales. The shares nonetheless down 1/3% in the early trade today. Speaking of cars, Tesla CEO Elon Musk is downplaying the steep drop in sales his company has seen outside of the U.S. Here's what he told Bloomberg's Michal Hussein when asked about European Tesla sales, which have fallen 39% this year through April.
Europe is our weakest market. We're strong everywhere else. Our sales are doing well at this point. We don't anticipate any meaningful sales shortfall, and obviously the stock market recognizes that since we're now back over $1 trillion in market cap. So Clearly, the market is aware of the situation, so it's already turned around.
Bloomberg's Global Autos editor Craig Trudell wrote about this as part of his Hyperdrive newsletter, which I get in my inbox every week. Highly recommend you subscribe to it as well. Craig, I knew when he said that he was kind of distorting the data some. Tell us the real deal in terms of Tesla sales and other automakers through the first part of the year.
Yeah, I think for me, the part of the interview that most was glaring was this notion that everybody's sales in Europe are down at this point versus where they were a year ago, and that just isn't true. You have at least 5 major manufacturers that sell more cars in Europe than Tesla does that have had sales increases in the first few months of the year. And not only that, when you just compare what Tesla is doing, relative to some of the companies that are seeing some declines, it is just absolutely an outlier in terms of the scope of decline. There is, of course, sort of an excuse that I think, Tesla and Musk are eager to bring up, this changeover to the Model Y, and that absolutely is a factor here. But I think there's, ongoing concerns about just how much he's alienated consumers in Europe, and even among government officials in Germany, where he has his lone plant in Europe. There's real concerns about workers at that factory sort of being caught up in the fact that he's become so much more of a divisive and polarizing figure, and how much that's sort of bleeding over to his company's brands.
Yeah, I think we can all see that happening. And as Michelle mentioned, there's so many Teslas now with stickers that said, "I bought this before I knew Elon was crazy." However, he made one, I think, really important point. The company is worth more than $1 trillion. So shareholders, for some reason, feel a lot differently than potential car buyers. What is that valuation based on? Because it sure isn't for selling a couple million cars every year.
Yeah, I mean, I think Musk himself has on several occasions said, our car business isn't what's important. What's important is AI. What's important is robotics and robo-taxis. And he's, I think, really messaged around those areas more aggressively than he ever has before. When you follow, Tesla's accounts on X and Elon's own account, it's sort of rare that a day goes by now where they're not sort of hyping up the product that they market as full self-driving, which is a driver assist system. It is not a self-driving system, and yet they've marketed it very aggressively for years, but I think really ramped that up as they look to next month and hope to offer some driverless rides in Austin. And NHTSA, the National Highway Traffic Safety Administration, has some questions about that, and just what Tesla has up its sleeve for next month.
All right, Craig, stick with us. I'm going to ask you to help me interview my next guest. Because you write the Hyperdrive newsletter, and I'll show a picture of that and encourage people to subscribe. Again, I love reading this in my email inbox every week because it gives me the intel that I really need to do this job. But I've got a guest who is a really important part of the EV landscape. ChargePoint and power management company Eaton have announced a partnership to accelerate and simplify the deployment of the EV charging infrastructure, which has been really I guess, bugaboo for a lot of people who are thinking about switching over. Hopefully this makes it a little bit easier. For more on the deal and for more on the infrastructure rollout, we're joined by Rick Wilmer. He's the president and CEO of ChargePoint. Rick, I will say, I had a great experience with your network from a consumer point of view that maybe worries me from a shareholder point of view. And that is, I'm test driving this Chevy Blazer EV. It's an absolute monster of a station wagon, 619 horsepower, I think, for $63,000. It's cost me $50 to fill it up with electricity at other places. I plugged it into a ChargePoint station in Carlisle, Pennsylvania over the weekend, and it cost me $9. Are you charging too little?
So, good question, Matt. And we don't set the price of electricity that drivers use to fill up their vehicles. We're a technology provider to institutions that want to provide EV charging, and there's a whole variety of reasons why institutions want to provide EV charging, but we're the technology provider to those institutions, and now doing it in partnership with Eaton. And depending on the reason they're offering charging, they may charge different rates for the electricity that they're providing to the drivers. In some cases, they may not charge at all. At our workplace, for example, we provide charging for free to our employees. There's other places that may charge for charging because they're trying to make money on the electricity, but it really varies from customer to customer, depending on what their goals are for EV charging.
Craig, let me bring you in here. As editor of the Hyperdrive newsletter, I thought Rick would be a great person for you to talk to. A lot of Americans are not convinced yet about EVs, and part of it is the charging infrastructure.
Yeah, Rick, I guess my question would have to do with, the level of support, and I guess carrot and stick that we've seen in the U.S. and the changes under the Trump administration. How much of a concern is that for ChargePoint that we both have some indications that the government is no longer going to be pushing manufacturers quite so hard and perhaps pulling some of the incentives for consumers to go electric?
Yeah, I mean, it's clearly a headwind, but the way we think about it is there's no longer many companies or institutions that are willing to pay a green premium, as well as consumers. So we've got to make EVs work for people, for companies, for everybody that's deploying chargers based on an economic basis. And when it comes to the EVs themselves, I am convinced, biased as it may be, that they're just superior products to gas vehicles. And as the penetration goes up, more people experience EVs, the selection continues to improve, which is driving the growth of EV sales in both North America and Europe. I think we're going to see more consumers adopt EVs just because they're a superior product. On the charging side, we've got to make this make sense for our customers economically, regardless of government incentives. And there's a lot of innovation that's going on now, part of it based on our partnership with Eaton, to deliver that value such that an electrified fleet of buses or delivery vans, for example, is less expensive to operate than a fleet of gas-powered vehicles. So that's what we're really focused on, is making this work economically regardless of government incentives.
Rick, one follow-up question to that. One of the sort of overarching themes that we write a lot about at Bloomberg is this notion that, these trade barriers that have been put up potentially, will complicate this transition to electric vehicles. We see that a lot with, things like batteries, whether it's the raw materials or components or just, in the end, the cells themselves. That, if the U.S. continues to keep up this stance of, not letting China in, that perhaps that will inhibit us from being able to bring prices down and convince more consumers. Are you feeling any of that on the charging side? Is there access to materials or technology that is holding back the charging experience for consumers in the U.S.?
I would say, Craig, not to the effect that it is for the automotive OEMs, but it's affecting everybody. So, it's obviously very dynamic and changing. Every time we get new updates, we continue to evaluate and determine how that may impact us. But our goal is to, try and optimize our supply chain arrangements and the way we do things, to mitigate the impact on our costs and the cost to our customers.
Hey, Rick, when I was downloading your app and plugging in over the weekend, it asked me if I wanted to use your product at my home or at a public, charging facility. What's the breakdown like in terms of that mix? And do you make more money on one or the other?
We definitely make more money on commercial chargers that go into, workplaces and, retail establishments and universities and schools and the like. Home chargers is a good business for us, but the real driver around home chargers is to continue to bring drivers onto the ChargePoint platform. That's very valuable for us to have drivers on the platform, and the home charger is really a great gateway for that to happen because, as you did, Matt, you download the app to configure it and install it at your home.
How many points do you have, and at what rate are you growing, I wonder, Rick? And then what's your market share like?
So market share in North America, it depends on whether you're talking about fleet or or commercial. On commercial, we're well over 70% of the market. On fleet, we've got a pretty substantial market share as well, and a lot of plans to continue to grow that market share in Europe.
Rick, great having you on the program. Thanks so much for joining us. Rick Wilmer there of ChargePoint. And our thanks as well to Bloomberg's Global Autos editor, Craig Trudell. By the way, you can check out all things cars on my weekly podcast, including this week, my review of that Chevy Blazer EV. It's a sleeper. It's an Autobahn cruiser. Hannah Elliott and I have a weekly podcast called Hot Pursuit, and I highly recommend that you listen to it if you care about cars. A check on stocks as we approach the top of the hour. We're looking at a drop in the market, though it's slight. We're still above 5,900 on the S&P 500, so still 250 points higher than we were on April 2nd, and still very positive for the year as well. The Nasdaq losing about 0.25%, and small caps faring the worst. Coming up in the next hour, a couple of notes. Mike Novogratz joins the show, so I'm super pumped to get his macro view as well as his crypto outlook, and one of my all-time favorite Bloomberg co-hosts, Scarlett Fu, joins me on loan from the close. This is Open Interest. We are 30 minutes into the trading day. It's hump day, and we're down. The S&P 500 off, only 0.5%, 59.11. So really not bad, up almost 300 points from April 2nd. The Nasdaq 100 down 1/3%. It's back in a bull market, and the S&P is close. The 10-year yield creeping up into danger zone at 453, but not soaring, up about 5 basis points. And I have Scarlett Fu with me on Open Interest today.
Such a pleasure to be here with you. You know, the S&P 500 down for a second day, but that was after that 6-day run in which oftentimes it would open lower and finish higher by the close. Now, I co-host the close from 3 to 5 p.m., and we'd often see the market turn around in that final hour. So you never know what's going to happen by 3 p.m. today.
Yeah, that's absolutely true. And we should point out also that the S&P is up year to date, so we're still in positive territory, gaining about 0.6%. Now, we have a great lineup of guests coming up this morning. First off, billionaire Mike Novogratz discusses the challenging path to Galaxy Digital's Nasdaq listing, and of course, we'll talk about Bitcoin as well, trading for over $100,000.
Can't wait to get his target. And we'll get the view from two market giants. Janus Henderson CEO Dibadj and Citadel's Ubide will be joining the show.
Plus, PGIM's Cathy Marcus tells us where she sees investment opportunities in the housing sector. Still a problem with rates over 7%. But as we saw from Lowe's and especially from Toll this morning, there is some strength in that market.
There is some strength. I mean, obviously you have a structural issue of not enough supply, and there's quite a bit of demand, especially with new household formations.
And rates. But
that is now a regular backdrop. I think everyone has gotten used to it. You know, mortgage rates approaching 7%, that's now par for the course.
Ouch. It's a tough course. Let's talk right now with Galaxy Digital. It's trading on the Nasdaq after a nearly after a long, drawn-out process with the SEC that reportedly cost over $25 million. Joining us to discuss is Mike Novogratz, the founder and CEO. Mike, great to have you on the program. Really excited to talk about a lot of other happy things with you, but I want to start with this listing. Why was it so long, drawn out, problematic, infuriating? What word would you use?
Listen, I would use the word un-American. The SEC under the Biden administration really just wasn't fair. And it's been a breath of fresh air with the new administration that their processes, they're looking at your business, they're doing what the SEC is supposed to do. And so we waited 1,307 days to go public. It kept us out of the deepest capital markets in the world. It put all the companies, not just ours, at a big disadvantage. But we're looking forward. We listed on Friday. It was a glorious day for, our Galaxy family. The Nasdaq does an amazing job of making you feel special. And we couldn't be happier to have finally cleared that hurdle.
Okay, so you cleared that hurdle, but as you said, it took a long time. So I'm curious as to how you feel the company, your company, has evolved since you first filed to list in the U.S.
Well, we're a very different company. Listen, I mean, sometimes scarcity makes you tough, and most of our growth was funded by trading profits and investing profits, and so it kept us very focused on not being wrong. What's changed? We're now really a holding company with two different divisions, right? We have a very large AI data center company. We've got a project in Helios called Helios down in West Texas that in the Panhandle that we think will be the largest data center in America by 2030. We already have 800 megawatts of power, and we're in the queue for more. We've got a great partnership with CoreWeave. I watch CoreWeave stock seems to go up every single day. And so we cheer for them because they're our tenant. We have contracts signed with them on the first 600 megawatts of our power to deliver a little bit less than that to them. And so that's a big business. And so we have that business, and then we have our traditional crypto business. And the crypto business really was built to be a bridge between institutions and the crypto community. And to be fair, I was really early. Right, this idea that the herd was coming was my tag phrase. They just didn't come, but they're here now. With this new administration, the regulatory clarity that we're starting to get from SEC, CFTC, FDIC, getting the right people in those seats who are pro-crypto. We just got stablecoin legislation on Monday, and so there's only one more hurdle for Congress, which is going to be called a market structure bill. But after that, it's up to the crypto industry to build something that America wants.
I do want to point out CoreWeave is up another 10% today, and the stock has more than doubled, tripled basically since the IPO. So yes, very successful tenant, a great one to sign up for that data center. In terms of Galaxy, you did have a decline in revenue in the first quarter, and a lot of people will find that puzzling since the price of Bitcoin was up so much, right? It rallied up through and over $100,000. Are you going to see a bounce back in revenue now that this legislation has passed?
Well, listen, so if you look at Bitcoin from start to finish in the first quarter, it was actually down a little bit, and Ethereum and the other coins were down a lot, right? Ethereum was down over 40%. And so we still have a big balance sheet, right? We have roughly $1 billion of crypto assets and another $400 million of venture private equity crypto assets. And so we have a lot of beta to the overall market. And so traditionally, our earnings have been very correlated with price. We are changing that quickly as our businesses become more stable, right? When we started, we made most of our money by being long at the right time and short at the right time. Now we've got a staking business, a lot of recurring revenue businesses that we're building, as well as this data center. The data center won't really be cash flow positive for another year, and then it becomes literally a cash machine. And so we hope the volatility of our earnings goes down when these other businesses come online.
So, Mike, the crypto industry is definitely having a moment right now. There's a listing of your company, Galaxy Digital, Coinbase joining the S&P 500. You also have the debut of eToro, and of course, the price of Bitcoin itself on an upswing today, hitting a record $108,000. Do you think the news around the crypto ecosystem is helping to drive the price of Bitcoin? What's wagging the dog here?
I think, listen, it started with Larry Fink. When he got orange pilled and the largest asset manager in the world said, this is a real asset in at least Bitcoin that everyone should be part of. And lots of other companies, Invesco with us, followed suit, right? And so that was kind of round one of institutions coming in. But really it was the change of the shift of approach from the Gary Gensler SEC to this Trump administration, which has just embraced our industry. And that freed up the animal spirits, both here and abroad, right? I've had conversations with heads of large sovereign wealth funds that said, if America's buying Bitcoin, we're buying Bitcoin. And so you're seeing like the snowball is rolling downhill. The one thing that could have held it back some, at least the Bitcoin price, would have been if, Scott Bessent and his team and Congress could have really knock that deficit from 7% of GDP down towards 3%, which was his plan. Right now, it looks like it's going from 7 to 8. And, I like Scott Bessent a lot. I think he's as competent and capable as anybody. We're in a really hard position as a country. And when you have this kind of debt, and you're seeing it with long ends of interest, yield curves are selling off everywhere. The dollar's under pressure. And that all is very good for Bitcoin and crypto assets as well.
Yeah, it was pretty shocking to look at weakness in the dollar and other haven assets. And for a long time, Bitcoin was kind of bucking the trend and going the other way, almost as if it was taking on a reserve currency status. I know that would be a fantasy for a lot of Bitcoiners for sure. I want to ask you about tokenization, though, Mike. You at Galaxy have tokenized a number of really cool things. I think I read you tokenized a Stradivarius violin. And you mentioned the new SEC. You want to tokenize your shares, or you're in talks with them to do that. How are those talks progressing, and when do you think that's going to be possible?
Listen, the SEC is really open-minded to people coming down with ideas. And so I think you're going to see tokenized equities, at least experiments with them in the next 1 to 2 months. I'm just throwing out a range. I don't know for certain, but it's going to happen. And tokenization itself, I keep saying this, is going to go real slow and then all of a sudden real fast. And I think, quite frankly, it might end up driving a lot of crypto adoption. People will be more comfortable owning Apple stock in a tokenized form, maybe, than owning a crypto. But once you start learning to go from an account to a wallet, the big migration in the next 5 years are going to be from accounts to wallets, right? This stablecoin bill is going to allow lots of new issuers of stablecoins, and all of a sudden, people are going to, in this device here, going to have their money market fund and maybe some of their stock and maybe some of their Bitcoin in a self-custodied wallet, as opposed to having to call their bank or their brokerage.
But you know what's cool, Mike? I've spent some time on our ETF program last year. Scarlett now co-anchors that. She kicked me off the set. And for a long time, we talked about the ETF of crypto assets. Will crypto now replace, will tokenization replace ETFs? I mean, is Eric Balchunas going to cover tokens instead of ETFs?
You will have a tokenized show in a few years. I don't think you'll replace. Listen, the U.S. capital markets are gigantic, but crypto is going to take a piece of it, and tokenization is going to grow much faster than people think. One of the advantages of having a tokenized stock is much broader distribution. I can envision a day where the young kid in Tanzania who's got a $2.37 savings has put it into a tiny piece of Apple stock, right? Like the democratization of being able to participate in markets is going to go limit up.
Yeah.
Because almost everyone on the planet has one of these. And it's going to be very easy to get, digital wallets.
Got it. Mike, really appreciate your joining us today. A pleasure speaking with you. Mike Novogratz of Galaxy Digital, and who knows, maybe we'll launch a tokenization IQ or token IQ show sometime soon.
I'll come back for that.
All right, there you go. Well, we're creating programming as we speak. All right, let's get a look at some single stocks that are moving at this hour. We're going to kick you off with Target falling after cutting its sales forecast. The retailer saw a sharp pullback in consumer spending, also a hit from tariffs. Toll Brothers gaining after the company reaffirmed its expectations for home sales for the year, saying that affluent buyers do remain resilient. That stock up about 1.4% right now amid a lower market. And UNH down on a report that the health insurers secretly paid nursing homes to reduce hospital transfers for ailing residents. Yet another negative headline here for UNH, which is calling the report verifiably false. Now, coming up on Open Interest, climbing mortgage rates are causing even slower demand for homes. We're going to speak with Cathy Marcus, co-CEO of PGIM Real Estate, next. Plus, TCW President Katie Koch says markets aren't pricing in all of the economic risk. We spoke with her at the Qatar Economic Forum.
We had the worst reading ever second worst reading ever in the history of the U.S. of consumer sentiment. The hard data hasn't yet caught up to that. The tariffs are not going to be as bad as we thought on Liberation Day, but they're still not going to be zero. And I think as we get more data that comes out, markets aren't priced for disappointment. They're now back to kind of record tights in credit and close to record highs in equity markets. And we would just say that's incongruous with the likely data that's coming out.
Mortgage rates in the U.S. are once again approaching the dreaded 7%. That marks the highest level since February. And the elevated borrowing costs are prompting a decline in applications for home purchases and refinancing. Joining us now is Cathy Marcus, co-CEO and global COO at PGIM Real Estate. PGIM Real Estate's annual Global Client Conference is currently underway in Miami, which is where she joins us from. Cathy, good to speak with you. I know PGIM is a long-term investor when it comes to real estate, but we know that mortgage rates follow Treasury yields. And right now, the bond market is fixated on the U.S.'s structural fiscal challenges, which is not going to be fixed anytime soon. So I guess my question to you, when you look at real estate overall, in what ways does the expected continued volatility we see in treasuries affect the fundamentals of U.S. real estate?
Well, as you mentioned, I'm here at our annual Global Client Conference. And what I'm hearing from our clients on the ground is the answer to your question is really not that much. And there is a lot of noise out there, but we're really focused on the things that we do know. And what we do know is that, and our clients are in agreement, and we've been hearing a lot from them over the last couple of days, around things like, focusing on the things that we know and the things that are really real estate market basic fundamentals. We recently had a pretty significant repricing. We've had very little new supply. Our occupancies remain high across most asset types, and there's plentiful credit in the institutional space from a broad variety of lenders. So we feel like it's really important to try to focus away from the noise and tune into the things that are actually the things that drive the commercial real estate markets.
What is the worst noise, though? I mean, let's talk about it, and then we can focus away from it. So what are the biggest headwinds?
I would say the worst noise is really, this idea of could we enter into a stagflationary environment? That's kind of the consensus worst case scenario. But we put that scenario at well under 5%.
Well under 5%. What about the prospects of recession and what that means in terms of where you want to be, not hiding out, but comfortably seeking shelter?
Yeah, I mean, we're really focused on resilient income. And that's one of the main benefits, I think, of real estate is that it's about income. It's about long-term contractual income through leases. So really where we're focused and where most of our investors believe that the greatest opportunities are right now, really regardless of the noise that's going on, are in things that are needs-based. So housing. We know that there's a shortage of housing. Last mile logistics. We know that there's a growth in digitalization, so data centers, and credit, really, and all different kinds of credit, from core to value add, that, resilient long-term income.
What about office space, Cathy? I don't know how deep into that you are, but clearly a lot of people are working from home now at least 1 or 2 days a week. So it's not as necessary as it once was for big companies to invest so much in office space.
It's not, although we're hearing a lot about, more and more people requiring, call it 3 to 4 days a week in the office. But the office sector has undergone, a major structural change that frankly started before COVID. And the office is now really a different place. The office is not necessarily a place where you go, you put your head down, you do your work all day. The office is about collaboration. And so companies really need different types of space that is going to attract people to come back to the office. So we think about office, it's been talked about nonstop for the past couple of years. And the reality is it's far less of a driver of the commercial real estate markets than it used to be. At this point, it's only about 16% of the institutional indexes, and it's only 4% of the public markets REIT indexes. And so there was a time that it was, close to 50%. And so office has just become, less of a driver and frankly, less of a concern. And actually, interestingly, we're seeing a comeback in leasing in certain office markets, New York being one of them, actually.
So when you talk about this comeback in leasing in certain markets, and you mentioned earlier that real estate values have reset, you take a step back, and the big picture here is that, you know, we saw a trough in real estate last year, but where we are right now is up for debate. Are we bumping along the bottom here, or have we hit the upturn?
We think that we've been at the bottom since mid-2024. And since mid-2024, when we really saw values stabilizing, we've experienced 3 quarters of positive total returns and even appreciation in some sectors and geographies. So we really believe that we are at potentially a generational buying opportunity, and that 2025 and 2026 are going to be excellent vintage years.
Cathy, great to get your intel. Really appreciate it and valuable to our viewers. So thank you very much for joining us. Cathy Marcus there of PGIM Real Estate at their global conference in Miami. Let's get a check of what's going on in the equity indexes. We do see a little bit of a drop, second day in a row. They didn't turn around to positive yesterday, did they?
They did. Well, the S&P, no, that's true. But in previous days...
So we did snap the 6-day winning streak.
Yes, but during that 6-day winning streak, there are plenty of days in which the market closed, opened lower and then closed higher.
I know, because I'm here in the morning and I watch your show.
Thank you.
Every day. The closed simulcast is probably my favorite moment on Bloomberg Television with you and Romaine and Alex.
3:58 to 4:10 p.m. Eastern Time.
And Carol and Tim. Definitely worth watching. In any case, we are down now for the second day in a row then on the S&P, 0.4%, the Nasdaq off 0.1, and the 10-year yield climbing, but only 3.5 basis points to 452.27. This is Bloomberg Open Interest.
This is Open Interest, a second day of declines here in U.S. stocks for the S&P 500. This is a look at the biggest contributors and decliners on a point basis. So we'll start with the decliners here. Amazon, Apple, Microsoft, NVIDIA. So a lot of Mag 7 names there dragging the index lower. United Health worth noting here as well. Another day of negative headlines on this beleaguered health insurer. The stock itself is down about 5.1%. On the flip side, the stocks that are keeping the index from falling further, and we have seen the S&P 500 pare some of its losses. Alphabet now up about 3%, Meta, Netflix, GE Vernova as well, and Keysight Technologies, some of the advancers here at the S&P 500. So you add it all up, and how does it look on a sector basis? There's a lot of red here. 10 of the 11 sectors in the S&P 500 down right now, with healthcare in the worst position because of United Health, down 1.25%. You go into communication services, though, that is the only group in the S&P 500 that is gaining right now. If you click inside of it, Joe, what you'll see, you ask and you shall receive, you do have declines in Take-Two Interactive as well as Keysight. So that's a big reason why that sector is now down, but or I should say not rising as much, but Alphabet is really the stock that is keeping that group lifted as a whole. Matt?
All right. Coming up, we're going to talk to Ali Dibadj, the CEO of Janus Henderson Investors. He says active management is key given the current geopolitical climate. This is Bloomberg.
President Trump is a deal maker. We know that. And that, of course, scared the market because the numbers and the statements were, obviously shocking. Now that people have seen a couple of deals, frameworks done, you're seeing the tax legislation move forward, they're getting more comfortable with the story. And so you're getting back to, okay, this is a storm, but we'll get through the storm.
That was Jenny Johnson, Franklin Templeton's CEO, speaking at the Qatar Economic Forum this morning. Our next guest says the U.S. tariff rollout will lead to more market turbulence. Ali Dibadj, CEO of Janus Henderson Investors, joins us now. You are at, Ali, your conference, Partnerships for a Brighter Future, and we're glad to get some time with you. Really appreciate it. Let me ask about the volatility we've seen. Obviously, already a 20% drawdown and then a 20% bounce back up. How does that hurt your confidence as an investor in U.S. assets?
Okay, I think this. Thanks for having me. By the way, it is a busy day here. We have clients from all over the world coming to our conference, tens of trillions of assets here. So we're getting a real play-by-play about what's going on as we look at the markets. And Matt, your question, I think what it really suggests is this volatility is here to stay. We thought we were, quote unquote, out of it most recently. I don't think we are anymore. I think the volatility is going to continue. And that really drives investors to think about a few things. For sure, to your point, becoming more global in the way one invests. More likely than not, people have invested significantly in the US to the detriment of other parts of the world. And I think you're going to see people, we are seeing people, even discussions at our conference today, shifting from US investments ever so slightly to the rest of the world, to UK, to Europe, particularly as they've come together, to APAC, the Middle East as well. And we're pivoting our firm, Janus Henderson, in that direction as well in terms of acquisitions, but also some of the investments that we have there from a fixed income perspective and an equities perspective, publics and private. So you're seeing people for sure see this volatility in the US and see opportunities outside of the US as well.
That's right, because Janus Henderson had talked about a 10% cut in U.S. assets because of all the tariff turmoil. Is that 10%, capped? Do you see it going to maybe 15% or 20%?
I don't think you're even at that 10% yet, Scarlett. We cheat a little bit because we hear from our clients what they're doing. Mm-hmm. And people are definitely talking about taking away a big chunk of their assets from the U.S. I mean, think about the global indices. You're talking about roughly 60% of assets sitting in the U.S. right now. If you just take 10% of that or 6 points of the market, that's a very big market to shift around to the UK, to continental Europe, to Asia, to the Middle East, to other parts. That is a small number, perhaps, on a relative basis in the U.S., but that's a big number in a lot of other places. So we're not quite there at that 10% yet, I would say, but I think it's fully in motion. Can we get to 15? Look, if things are still volatile, you could potentially see that. We're happily prepared to receive those in a lot of our global investment funds. Roughly half of our assets are outside the U.S. as a firm. But certainly, if the volatility continues, it could go beyond that. We're not there yet, though.
You know, we did see, obviously, the Friday after the market closed, Moody's downgrade of the long-term U.S. credit rating. And I thought that would push more investors to buy bonds. I thought that would push investors to JGBs. Japan also had a very difficult time selling its debt. Where are investors going if they're scared out of the U.S.?
Yeah, it's a great question, Matt. On the fixed income side, I say it's bifurcating in two areas that we're hearing from our clients and we're seeing, and hopefully we're delivering for our clients on that front. One is the shorter end of the curve domestically in the U.S. So think about both on the public side of things. Securitized is a great area. Public securitized is a great area. We have, as you guys know, a number of ETFs in that marketplace. We're the leaders in active fixed income ETF and a lot of the securitized areas, JAAA, JBB, those types of products. So people are going there for sure on the shorter end of the curve. They're also going to higher quality, more stable, I guess, international areas from a fixed income perspective. Think of our Australian fixed income business has been on a tear recently, people trying to put money there for sure. We also have an emerging market debt business, but it's more on the sovereign side of things, and it's on the hard currency side of things where we're seeing a lot of interest. So people are basically bifurcated, short end of the curve in the US, and stable long-term bets on some of the areas internationally from a fixed income perspective.
Are people looking at alternatives like private credit? And I know that you guys recently acquired Victory Park Capital, which is a global asset-backed firm, really focused on private credit back in 2024. Are they looking at alternatives as a safe haven, not substitute, but addition to fixed income?
Yeah, Scarlett, they very much are. And again, there too, you're seeing a few things happen. One is private credit is such a broad term these days. You're seeing within private credit, people are looking much more towards the asset-backed side. Mm-hmm. What's interesting, and you mentioned Victory Park Capital, people are now looking at asset-backed. It's kind of the cool, exciting thing that people are looking at. Gladly for us, Victory Park Capital, one of our firms, has been doing this for 20 years. And we see a lot of interest there. The direct lending side of private credit is a place where people already have exposure to for the most part. And it's becoming a broadly syndicated loan market. So not as much opportunity there, we would say. But asset-backed is certainly a place of interest. The other element, it goes a little bit to Matt's question earlier on, is on the private credit side internationally as well. So we brought on board, for example, a team that's specialized in investing in a very big growth economy, the Middle East. This is a team that was captive within a wealth platform. They do private credit, but in the Middle East, which is seeing enormous inflow of investment and activity. And obviously the trip last week by our president did drive a lot of attention there. We've been there for quite some time, and that team too has been doing it for 17, 18 years in that region. So we are seeing people looking for alternatives, definitely on the CLO side, which is the securitized public side we have, but as you mentioned, on the private side as well.
We have a story on JPMorgan today creating an entire unit dedicated to following geopolitics. How do you serve at Janus Henderson investors' hunger for news on tariffs, views on, I don't know, the growing deficit? I think geopolitics have never been as important as they are right now with hot wars in Israel and in Europe and Ukraine. How do you deal with that kind of need?
We've had the benefit of having a head start, I guess. We've been talking about geopolitics as part of our three big immutable themes for our investors and our clients for the past probably 3 or 4 years at this point. So we've had a head start. We've built out really great thought processes on the geopolitical realignment that's happening. And again, it's immutable. It's going to continue to happen. And we've been working on that for a very long time. Our portfolio managers have to think about it all day long. Our answer, Matt, honestly, is we have 350 people around the world who all they do is invest. And one of their big themes is about geopolitical realignment. That impacts obviously supply chains with tariffs and how do you invest in real estate? How do you invest in technology companies and where they have their manufacturing facilities, whether they're going to be embargoed or not from chips perspective. We invest in different areas of the world that really deliver innovation and have to be able to overcome some of these supply chain changes. We use politics actually as a lever in some of our investment strategies. I mentioned emerging market debt, but certainly emerging market equity as well. That's what we've been doing for, look, our company's been around for 91 years, but we've been certainly thinking about this one theme for a very long time already.
All right, good stuff. Ali, really appreciate you joining us and sharing some time with us. Ali Dibadj of Janus Henderson Investors from their exclusive client conference. In terms of how things are shaping up in markets right now, about an hour after trading began, we have a decline here in the S&P 500. Second day of losses for the S&P after, of course, a 6-day rally. And you're seeing some weakness there in communications, the healthcare stocks in particular, communication services bucking the trend right now with Alphabet higher. The 10-year yield and yields across the curve continue to move up, Matt.
Yeah, and it's interesting. I mean, I was poo-pooing earlier the gain of only 4 basis points, and you pointed out there was a time when a 4 basis point move was a headline.
Yes.
And that kind of volatility we've seen obviously in equities as well, because so often Katie, Sonali, and I kick off this show and talk about a down day that by the time I tune into the close is gaining. So we could see those kind of moves, which is why you have to stay tuned into Bloomberg television. Also because Europe may need its own sovereign bond. There's been a lot of talk about this, but the Trump administration may push them even closer. We're going to talk to Citadel's top economist next. He thinks so. Angel Ubide joins us. This is Open Interest. Let's get now to high interest. Look at what's making headlines around the world. Advisors to President Trump are considering a new directive that would pave the way for private equity to become a bigger piece of U.S. retirement savings. The goal is to offer savers more investment options and potentially greater upside. However, greater risk and higher fees could leave retirement plan administrators vulnerable to lawsuits. NVIDIA's CEO Jensen Huang is criticizing U.S. restrictions on AI chip sales to China, calling them a failure and urging the White House to lower barriers. He argues that if American firms like NVIDIA aren't allowed to sell into China, local customers will spend their money on chips from other companies like Huawei. Instead, China is expected to be a $50 billion opportunity for AI technology next year. And the European Union has shared a revised trade proposal with the U.S. as it tries to inject momentum in talks with President Trump's administration. The new paper includes proposals that take into account U.S. interests, including international labor rights, environmental standards, economic security, and gradually reducing tariffs to 0 for non-sensitive agricultural products and industrial goods. At the same time, the EU is moving forward with preparing countermeasures if negotiations fail to produce a satisfactory outcome.
All right, Citadel's top economist Angel Ubide says the ball is in Europe's court on trade negotiations, and he's also making the case for a Eurobond. He argues that quote, such a tool would be helpful as it's good to have another leg on the stool versus relying on just U.S. and China. Angel Ubide, Citadel's head of economic research for fixed income and macro, joins us now. Great to see you here. Thank you so much for coming in. This idea of a Eurobond, I feel like it comes and goes. It's come up before in the past and then it kind of fades. It's back again. Why is the time right now? Why is the time right now to have this conversation? I got my words right.
Well, it is the time now, and the time is right for two reasons, right? If Europe is going to achieve a strategic autonomy, it's going to have to be strong in economy, in defense, in security, and in financial markets. And the only way you can be strong in financial markets and independent is having a strong and deep and liquid bond market. And right now, it doesn't have it.
Who are the biggest proponents to that? I remember I was stationed in Germany for the 6 years ending through COVID. And they did sell, I think, 750 billion euros of bonds, which were successful. So who's fighting back against this at a time when Friedrich Merz has convinced the Germans to spend $500 billion?
So I think you said it exactly right. The experience with the next generation EU was a success. And it was a success because it made the Eurozone more stable. You remember there was no fears whatsoever during the COVID period of any country losing market access. And not only that, countries, and my home country, Spain, Italy, everybody, boosted public investment. Why? Because they knew they had access to a liquid bond market via the issuance of those Eurobonds. So now Germany, as you very well said, has gone through a change. They have moved from austerity to investment. I always say it's not about savings, it's about investing when you are in these big structural geopolitical changes. And now Germany is in favor of investing. The question now is how to fund it. And how to fund it, in my view, especially when you have high levels of debt, is creating fiscal space. And you create fiscal space by improving the structure of your debt. And that's what Eurobonds at the end could achieve.
What kind of demand is there from institutional investors for this? I mean, is this something they're clamoring for?
So listen, it's quite simple. The German bond market is around 4 trillion euros. That's very small compared to US Treasuries. So when you are a big institutional investor in the rest of the world, I'm not even saying US, think Asia, and you want to increase your allocation to European assets, where do you go? You buy a little bit of bonds, a little bit of French bonds, and that's it. You need to create your own basket. If you could create a liquid and big market for Eurobonds, it would attract a lot of investors that right now are at a loss. They don't really know what to do. They have doubts about US Treasuries, but they are not convinced of where to put their money in Europe.
I guess the concern is, it's interesting that you come now, Angel, because we're in a situation where it looks like Congress is going to push through a continued cap on the state and local tax deduction, which robs states of sovereignty in order to give the federal government more centralized power. And this is a concern in Europe, right? The Germans, the French, the Spanish don't want to cede sovereignty to a big federal European government. Do you see any threat of that, a European federal tax, for example?
So let's put it this way. You cannot create Eurobonds out of nothing. There will need to be some revenues that are going to be backing those bonds and the debt service of those bonds. So there will have to be some shared revenues. This is what the discussion in Brussels has always been about, improving their own resources. So that is a fact. But the question is, listen, the world is changing. It's going to be more difficult. It's a new geopolitical environment. Do you want to get stronger or not? If you want to get stronger, do what it takes. And if part of that is relinquishing a little bit of that sovereignty for the sake of the higher good, now is the time to do it. And it's now or never. And the clock is ticking.
What are the political considerations, though, for individual countries? I mean, I know you're an economic advisor to the Prime Minister of Spain, Pedro Sanchez. What would someone like Pedro Sanchez say in terms of why he might be a little bit reluctant here? What does he need to fold in?
Listen, I think at the end of the day, this is a matter of trust, right? There is a big difference between the US and Europe. In Europe, we have very complicated rules, defined to the decimal point. Think about the Stability and Growth Pact, the fiscal rules, everything. Why is that? Because we don't have a political union, so we need to write more complete contracts. In the US, it's different. You have a constitution from, 200-300 years ago that people can interpret, but there is that trust that everybody's in the same team. In Europe, you just need to advance that trust. And I think from the point of view of each individual country, that is the issue. If I give you this, what am I going to get in exchange? And in exchange, if it's done right, is a stronger economy and a stronger political entity that can face the risks that are growing and that are going to be there for the next 10, 15 years.
Angel, absent a Eurobond, where do you see money going as this administration pushes essentially for deglobalization? And foreign investors then say, why am I financing this by owning U.S. assets? Where is that money flowing to?
So I'll tell you, it's a very interesting situation. U.S. investors right now are still thinking between U.S. equities and U.S. bonds. Non-U.S. investors are thinking about rebalancing their portfolios away from what was a very overweight position on U.S. assets to something that is more balanced. So I was looking this morning as I was preparing for this. If you had put your money on November 5th on the U.S. equities versus European equities, the trade was to be long Europe and short the U.S. because Europe has outperformed around 10%. That's what tells us there is this rebalancing that is happening. It's going to go towards European and other assets. The question is how much of that Europe wants to capture. The more attractive it makes it, the better.
The demand is there. You just now need to create the supply
exactly.
to fulfill it. All right, Angel Ubide, thank you so much. A pleasure.
My
really
pleasure.
enjoyed talking to you. Head of Economic Research for Fixed Income and Macro of Citadel.
As well as an advisor to Pedro Sanchez.
Yes, that's right, the Prime Minister of Spain. All right, coming up, House Speaker Mike Johnson here in the U.S. says Republicans have reached an agreement on a major sticking point holding up President Trump's economic bill. This is something Matt and I pay a lot of attention to. We're going to get the latest out of Washington next. This is Bloomberg Open Interest.
House Speaker Mike Johnson says Republicans have reached an agreement to continue capping the state and local tax deduction. That clears a major hurdle in passing President Trump's economic bill and centralizing power in America. Joining us now from the White House is Bloomberg's Tyler Kendall. So, Tyler, we know, I suppose, some details that they want to raise the cap that Trump initially put on in 2017 to $40,000, but cut it off for families making more than $500,000 a year.
Right. So that is what our reporting is indicating at the moment, Matt. It also doesn't address the marriage penalty, something that we know Republicans from these high tax states really wanted to see. But at the moment, we are waiting for something known as the manager's amendment. You're going to hear this term come up because that is what's going to actually outline the changes to the underlying bill text. That's going to put into writing what we have been reporting. The thing is, that's supposed to happen during the Rules Committee, which is meeting right now. But they started meeting at 1 a.m. Eastern, and we still have not seen a manager's amendment, which signals to us that behind the scenes, there really are still some tough negotiations that are ongoing. In fact, we heard almost immediately from some more of the conservatives in the party after House Speaker Mike Johnson did confirm that the $40,000 cap was on the table, that they were unhappy with that agreement. In fact, the chair of the House Freedom Caucus, Andy Harris, did tell reporters that he had a midnight deal, as he called it, with President Trump to see some deeper cuts when it comes to Medicaid and also speeding up the phase out of some clean energy tax credits under the IRA. Those were two of the other big sticking points in this deal. So we're going to have to see how this all shakes out and whether or not it can get done, Matt, by House Speaker Mike Johnson's timeline of Monday, because now these fiscal hawks are threatening to basically torpedo the vote.
So the fact that that meeting is still going on, does that suggest that the $40,000 limit that we're talking about here is not a completely done deal, even as Speaker Johnson has talked about an agreement being reached?
Right, exactly. So we're going to have to see how the ultimate negotiations happen. As of now, that is our understanding, that that does appear to be the sweet spot. We had gotten indications leading up to today that $40,000 cap did appear to be a number that perhaps these members from these high tax states like New York, New Jersey, and California could get behind. But we are still waiting for those actual details in writing to tell us about phase outs, income limits, whether or not this would actually come back down over time, as well as whether or not that marriage penalty will ultimately be addressed. So we're going to have to see if perhaps some things could change here, as it appears evident, Scarlett, that they are still talking behind the scenes.
All right, Tyler, thanks very much for joining us. Bloomberg's Tyler Kendall there at the White House. And thank you very much, Scarlet Fu.
It was a pleasure.
For joining me. It was a great fun, and I know you're going to have a fantastic time on the close later.
Yep.
You co-anchored that with Romaine Bostick and Alex Steele from 3 to 5. Every day. You have a special guest today.
We do. Leon Cooperman, the legendary investor, will be joining the close today and the 3 p.m. hour at 3:30 p.m. So make sure you tune in to that on Bloomberg Television. You can also see it on the Bloomberg Terminal in the Spotlight box. Leon Cooperman will be joining us at this pivotal moment here after Moody's downgraded the U.S. Trump tariffs have created a lot of volatility. Yields are continuing to move higher and show no signs of stopping.
Well, absolute Wall Street legend. I'll definitely tune in for that. And tonight on Bloomberg, an exclusive interview with JPMorgan CEO Jamie Dimon. That's late, so stay up for it. 11:30 p.m. New York time, or set your DVR. Tomorrow on Open Interest, Mike Wilson joins us of Morgan Stanley, as well as Gabriela Santos of JPMorgan.